Hello, everyone, and thank you guys for tuning in to part 2 of our Business Succession Planning and Insurance Essentials series.
Thanks, Jillian. Thanks to Yorkville Management for asking me to join you today.
All right, so to get started, we will be introducing the role of estate planning in family business and how insurance can be an important part of that. And then we're going to get into our two main topics that we're focusing on today. So the first being the shareholders agreement and their importance in a business and business planning. And then we're going to get into the use of insurance in shareholders agreement. So first off, I'd like to introduce myself. I'm Jillian Wade. I'm the CFO at Yorkville, and as well, I'm on the portfolio management team. For those of you who don't know Yorkville, Yorkville Asset Management is a boutique wealth management firm with clients across Canada. Our focus is managing money for high net worth families, individuals, foundations, and institutions. Next, I would like to introduce Sandrine. So Sandrine is an insurance specialist at YAM Financial Solutions, which is Yorkville's insurance arm of our business. So Sandrine, I'm going to pass it off to you to introduce yourself.
Thank you, Jillian, and thank you, Blair, for joining us, and thank you, everyone, for joining us on this webinar. My name is Sandrine. I'm excited to be speaking today about insurance. I'm an insurance broker representing YAM Financial Solution. I have 5 years of top one insurance experience at Manulife, where I won 2 Emerald Awards. In the last year, I've had the opportunity to win the People's Choice Award at the Richmond Hill Board of Trade and be part of Yorkville. I work with individuals, family offices, corporations to ensure they have adequate insurance coverage. This includes helping clients implement estate planning, generational wealth, and other tax saving strategies and fortify their business with insurance.
Perfect. Thank you, Sandrine. And next, I'm going to introduce Blair. Blair's at Botsford Law. So thank you, Blair, for joining us today. And I'll pass it off to you to go through your extensive experience in this area.
Yep, thank you very much, Jillian and Sandrine. So yes, I'm a trust and estates lawyer. I've practiced for over 25 years. Actually, it's 28 years now. I can't believe where the time has gone. So my practice includes all ranges of will, trust, and estate planning, assisting executors and trustees with administration of estates or trusts, dealing with consent and capacity issues. I have clients who are, individuals, business owners. I've advised financial institutions. I also deal with clients who have sometimes assets or other exposure to foreign jurisdictions. And I'm a member of a range of professional organizations from the Law Society of Ontario, Society of Trust and Estates Practitioners, the Ontario Bar Association, International Bar Association, and Canadian Tax Foundation.
So just a little bit of experience.
just a little snippet there.
Great. Well, we're glad to have you here today.
Yep.
All right. So over the next couple of months, Sandrine and Blair are going to host 4 webinars on succession planning and insurance essentials. So this is the second webinar. And Blair, I'll have you go through what you've been talking about over the 4 webinars.
Yeah, so part 1, so the previous one we did really looked at estate planning and the role of trust in it, particularly for asset management and asset protection purposes. This session is the one about shareholders agreements and their role in the estate and business succession planning process. And then the 2 to come are I'll look at the legal implications or aspects of immediate financing arrangements, and then we'll wrap up by trying to tie together estate and business succession planning and how they really complement each other.
Perfect. Great. Thank you, Blair. Sorry, I did flip slides too early, but here we go. So Sandrine, why don't you take us through how you're going to complement Blair's topics with insurance strategies over the 4 webinars?
Thank you, Jillian. Thank you, Blair, for going over that. So over a series of the webinars, we're discussing various topics. Last series, we talked about creating an estate plan with insurance and different types. Today, we will dive into buy-sell agreements and key man insurance. And then in the next two topics, we'll go over IFAs as well as other insurance types and strategies that businesses and business owners can look at.
Perfect. Thank you, Sandrine. Okay, so let's get started on today's topics. So first, Blair is going to be talking about shareholders agreement in estate planning and business succession. And then Sandrine will be taking us through the insurance funding for shareholders agreement and then life insurance for the key man in your business. So Blair, I'll pass it over to you to start.
Yep, thanks, Jillian. So, shareholders agreements, I mean, they're broadly considered a business agreement. Generally speaking, people wouldn't think of them as an estate planning or business succession planning agreement. But really, they do tie in quite nicely and in a useful way to estate planning. So, estate planning overall has three main goals: asset protection, asset management, and then often there's a tax component, tax minimization. That's a broad topic on its own, so I'm not going to get into the weeds on that today. I might touch on it just a little bit here and there, but focusing on the protection and management side. So looking at understanding, what is a shareholder agreement and there's a whole host of things they can do, issues they can tackle. And I've broken it down into two buckets. One is the more business related issues of setting up things like capitalization, when do shares vest, anti-dissolution rules, so protecting existing shareholder rights in the event that there's a further issuance of shares, quorums for meetings, operating guidelines like budgeting, what have you, winding up of the business. Not that business owners tend to want to think about winding up the business, but it may happen at some point. And restrictions on conflicts of interest, non-competition issues, and dispute resolution. And so really that clarity coming out of tackling the range of business issues, it might not seem like a significant thing or why it's related to business succession planning, but by minimizing conflict between the shareholders and when you get rid of or minimize that element, it helps protect the longevity of the business, the stability of the business. And, if it's going to be sold or looking for further rounds of investment, people don't want to put money into a business that has problems. So when you just do the practical things on the business side, make it run as smoothly as possible, you're going to minimize bumps in the road that can affect value. And that's part of the asset protection management standpoint, because for a lot of business owners in the small to medium size enterprise, the SME space, this is the big chunk of their estate. So people want as much value as possible. So great, deal with the relevant issues customized to the needs of the particular business to make it run smoothly. So then you're maximizing the value, and what's in the estate are the business owner's shares. And then that's where elements of the shareholders agreement are important from the estate planning and succession side, because even relatively innocent provisions, definitional provisions like permitted transferees, because a lot of small businesses don't want shares just landing in the hands of random people, even if it's a surviving spouse, the kids, cousin, something like that. I mean, so clarity there. And I'll talk in a few moments about some unique considerations around permitted transferees. But looking at share sales and transfers, when is that triggered? Is it on short-term disability, long-term disability? What is the length of time someone needs to be experiencing a disability so that it would trigger a share transfer requirement because the person's not actively involved in the business anymore? various buyout provisions, and there are different kinds of structuring. A lot of people have heard of shotgun clauses, but they don't work for everyone, especially if one shareholder has all the power. You don't want to be the minority shareholder pulling the trigger because the thing's probably going to blow up in your face and not really impact the person with all the power. But there are other ways, other structuring of buyouts and tag along rights, drag along rights, what have you. And something that's often overlooked is allocation of tax accounts. You can deal with things like share valuation, etc., personal guarantees. So the whole range of things that really impact the shareholder personally. And then that ties into their estate planning. So Jillian, I'll get you to flip to the next slide.
Perfect.
So again, the sort of how various components of estate planning fit together, symbolized by the diagram there. So sort of the asset protection management ties neatly together. And what I was saying a minute ago about the permitted transferees definition or similar term in a shareholder agreement, sometimes the partners, the shareholders, they don't want, say, a surviving spouse who's not actively involved in the business to get the shares, and then the surviving business owner is dealing with that person. So sometimes we see people just say, okay, you can't transfer to a spouse. The problem with that is that the Income Tax Act has provisions for rollovers. So from the tax and estate planning side of things, a person who passes away may want the rollover treatment as part of their post-mortem tax planning strategy. So the way we deal with that is allow a broader range of permitted transferees, like a spouse, like children, because it's going to be a natural part of estate planning. What we do then is have these share transfer mechanisms looking at what might be, compulsory provisions that if X happens, then there are rights of the corporation and the surviving shareholders to buy back the shares or buy out the shares. So it's assumed they're going to trigger that and yank the shares from the spouse. So that spouse gets paid out. But it really is a cake and eat it too situation. You settle up the estate affairs, hopefully, and we'll get to a key component of that in a second as well. And then, the clarity around the share transfer provisions and looking at what are realistic post-mortem planning strategies, whether there's anticipated a pipeline, bump transactions, loss carried back, making sure the upfront planning is going to allow for that flexibility and allowing the people to carry that out and do their independent planning without interfering with the company and how it operates. So tax minimization, again, not going way into the weeds here, but clarifying the share valuation, what's included, is insurance included, or how's it going to impact valuations? Because there are a variety of different ways to value a business, and some are better or worse depending on the nature of the business and the market it operates in. And funding of buy-sell provisions is important, and also dealing with things like the tax accounts, who gets the benefit of the CDA account, the capital dividend account. There may be an accrued balance over the course of the business prior to someone passing away, prior to an insurance payment being received, and then it's bumped up even further. If the agreement and the parties are silent on what they want to do with things like that have incredible value, then you could get into a fight between the various parties on how that's going to be shared. Is it supposed to be the last shareholder standing gets the whole CDA balance? Is it prorated over the various shareholders as they pass away, so it ties into the post-mortem planning? But point number 2 under that heading, the funding of buy-sell arrangements, probably one of the most critical, because you could have the most beautiful planning in place and the accountant has got this great post-mortem strategy. Everything's buttoned down. And oops, how do you pay for this? And that can lead to a whole host of problems. But Sandrine has some solutions on how to overcome that and make sure there's appropriate liquidity.
Thank you, Blair. You pointed out some very important information. I think all businesses should be talking to you at some point. So as you mentioned, when thinking about shareholders agreements, many people forget to fund the shareholders agreement, which can constitute a liquidity problem at death, as Blair was talking about. Life insurance is one of the most efficient and cost-effective way to fund that. It provides instant liquidity to businesses. Businesses should think about if their business is prepared, if a shareholder dies, and what would they want to happen to their interest in the business. Most of the time, agreements are in place, but businesses don't have a real solution to fund that. Crisscross is one of the most popular funding, which consists of business owners that buy insurance based on the shares value of the business that is predetermined. At death, the other parties can buy out the shares. In a situation where the successor of the shareholder does not want to take part in the business or does not have the necessary skill sets. Another solution that life insurance funding provides is the ability to buy the shares without selling assets, without borrowing funds or a sinking fund. A couple of important considerations that businesses should take into account from the deceased shareholder's perspective. 1, how will the estate pay tax liability? 2, do my heirs want to be active owners in the business? 3, is there a market buyer for the shares? 4, do my heirs want to receive full value of the share or rely on future of the business for ongoing expenses? From the surviving shareholder's perspective, the important consideration are: 1, do they want to be in the business with the deceased shareholder's heirs? Do they want their hard work to pay dividends to the deceased shareholder? 3, do they want to sell business asset to generate fund to purchase deceased shares? Buy-sell ensures a buyer of the shares, guarantees heirs at a fair price, offers protection from unwanted shareholders, allocate funds in an agreed manner, and establishes a method of determining price. Other option and structure for buy-sell agreement that exist are crisscross purchase that we talked about, shareholder redemption, hybrid, and promissory notes. Depending on each business needs, we could fit the business's goals and unique circumstances. Next, thank you. As part of shareholders agreement, it's important to also consider key person insurance. Key person protection uses life and critical illness insurance policies to help you protect the business from the cost that result from the death or the illness of a key person. Have you considered all possible costs of losing a key person? Similar to buy-sell agreements, life insurance and critical illness are taken out on the life of the key person. That doesn't necessarily have to be the shareholder. It can be an employee or a director that has a unique skill set, and that without them, there would be a negative consequence on the business, or that the cost to replace them would be very high. Life insurance protects the key person upon death. Critical illness protects the key person in the event of a life-threatening illness in which they would need to take time off work. Steps in setting up a key man or a key person insurance. Identify the key people. Those are the individuals on which the business relies on heavily. Second, estimate the financial impact of losing the key employee. This could include replacing business income that the key person is generating, recruiting and training new hires to be up to speed, and any debts or revenue losses that comes with losing a key person. You can come talk to me as your insurance advisor once you identify the key person and the risks associated with. We can take the next steps to minimize the risk. In this case, the insurance company takes on the financial risk and protects you and your business. How it is structured is insurance would be owned and paid for by the business. The policy is on the key man's life. If the key person dies or has a covered illness, the amount that we predetermine is paid to the company tax-free.
Perfect. Well, thank you, Sandrine and Blair. You've given us a lot of information today that people will need to digest, and then they can reach out if they have any questions. For now, I do actually have a few follow-up questions for you. So Blair, my question to you is, I know you touched on this but you went through a lot of information. So I was hoping you could re-emphasize the key things that people often miss out or get wrong when putting together their shareholders agreement.
I'm going to say, well, the key thing they get wrong is not doing a shareholder agreement, or they start the negotiations and then somehow they don't finish it. And I get that it takes some time. There's some cost involved for sure. And sometimes it involves some uncomfortable conversations. Either it's talking, the shareholders talking about their mortality. And so either leaving aside the problem of not starting and not finishing generally is they'll skip over the estate planning parts of dealing with what happens on disability, like not really dealing with what happens on death. So they deal with strictly business issues. So I'd say, well, we'll do that. We'll come back to it. And we'll amend later. No, it's great just while you're thinking about it. So either not doing it, missing out all the estate planning related parts. And then of course, I'm going to say the other big problem is them being too optimistic about, well, our company is growing like mad. It's got all this value. The numbers are there, the zeros are there. Why on earth would we need a funding mechanism to deal with the purchase or redemption of shares on death? So the liquidity problem is huge. It can really tie up an estate, drive litigation. So, if people are that close to the finish line, really look at the practical implications of how are you going to deal with the buyout, the share transfers later.
Perfect, thank you. And I'm sure probably people starting shareholders agreements just take like a standard shareholders agreement, sign it, and then forget to make it their own.
Yeah, I mean, we see a variety of things between people doing the dreaded, download off the internet DIY solution, or, they treat it as a business transaction. Well, my corporate lawyer, like, this is business. My corporate lawyer can deal with everything all on their own. I don't need to knit this into my estate planning and deal with these other issues. And yeah, if people put blinders on, they can run into trouble.
Great, well, thank you. And Sandrine, you mentioned different options to fund a buy-sell agreement. Can you quickly go over the difference between the crisscross insurance compared to a share redemption?
Yes, of course. So we talked about different structures. So the crisscross insurance is where shareholders buy insurance to buy out each other's shares, versus share redemption is where the corporation buys a policy on the shareholders and the corporation buys out the deceased shareholders' shares. So one of them is purchased by the shareholders, and then one of them is purchased by the business.
Okay, perfect. That makes sense. In our last webinar, we talked about whole life and term life insurance. What type of insurance is used to handle shareholders agreement issues versus key man insurance?
Yeah, so for Keyman, since it is to protect shorter term in the business, it is the most common is the term life, because as the company grows, the Keyman risk decreases. And then for shareholders agreement, it's more common to fund it with a whole life, as it is a long-term strategy, including retirement. But we can always discuss the specifics to each person's situation to determine what will work best for everyone.
Perfect. Well, thank you. Thank you, Blair. Thank you, Sandrine, for your time. And please stay tuned for the next 2 webinars.
Yes, and I also wanted to mention that the recording is going to be on YouTube, so we'll be sending out the links, and then you can review that and all the other series as well. So you'll have series 1, series 2, series 3, and series 4 as well.
Perfect. That's great. Thanks, Sandrine. Have a good day, everyone.